Now, on this week's Purchase or Pass, we check out a multiple property on a single title. Now, this property consists of a 3-bed, 2-bedroom, 1-bed unit in a converted house style of a property with double frontage. It's 6.9 kilometres from the city and 1 kilometre from the action. The property has recently been renovated and gets around $2,200 a week rent, and it's got an asking price of $1.5 million. So, John, what's the main attraction of going for a property with multiple streams of income on the one title?
Well, at the end of the day, what this is all about is actually the yield that's available on it, and the yield's very attractive. I had a very quick look at this particular property on the internet. I was a little bit, frankly, disturbed by it. There looked to me to be some inherent problems with it. I also had a question whether it was in fact approved by council, and that's something that I think that everybody ought to consider very carefully. And then I looked at the structure of it all and could see some cracking above some windows and other things. And so I was a little concerned about the property in terms of, was the rate of return really there when I got to fix it up, and would I in fact be always allowed to rent it out as it currently was and get the income stream? Because if I couldn't, I didn't think it was worth $1.5 million. So there are a couple of lessons in that. I think you need to go and check your council. Number two, make sure that the building is really sound and effective. And if all of those things work, then just remember one other thing, and that is, unless you can strata this, you're not going to get the capital growth out of it that you really ought to get.
Because ultimately you can't sell it in bits and pieces.
And there are rules with respect to strataing that you've got to remember too. Veranda areas have got to be a certain size and relative to the floor area of the unit and things. And so I didn't think this particular property was stratable at the end of the day. I was a little bit concerned about its structure. I loved its return. However, I passed.
Right, okay. And I mean, typically with niche properties, is it something that generally might get more capital growth, or is it very much dependent on that particular property?
Capital growth is a function of demand when you go to sell. And if you've got a niche property, by definition, it's niche. Therefore, by definition, the number of people that are going to bid for it or look for it are actually smaller than you would normally get for a normal property. So unlikely to get the same level of capital growth out of it. These sorts of properties are really return properties in terms of recurrent cash flow.
Yeah, and so obviously the major advantage is something like 7 or 8% rent return in a great area, obviously.
Make sure it's, however, sufficient to provide for the fact that probably your capital growth is going to be less.
Maybe slightly less. And certainly the other downside you've got to think of is quite often the banks consider these slightly different as well. Quite often they'll treat them as commercial, so they might only lend 70%, and then certainly there might be higher interest rates as well.
That's right.
So again, wherever there's extra advantages, it always comes at a price, and there's a balancing one there. So John's certainly going to pass on that one. But certainly for me, I think this is an investment it's not one for the everyday investor. It'll only suit a certain type of person that's got the extra cash for a deposit and who wants a high yield as well as some potential growth in a blue chip suburb as well. Certainly a fantastic yield, an OK area for a great suburb. So for diversification, I'd certainly purchase it, subject to checking out some of the comparable sales and certainly the building, as John said as well.